Welcome back to The Deep Dive, your essential shortcut to being well-informed, without all the noise. Today, we're really getting into the weeds of the second quarter 2025 earnings call for Teck. They're a true titan in the mining sector. We're going to unpack their big strategic moves in copper, see how they're handling some, unexpected operational bumps, and also, crucially, how they're managing all that while still sending significant cash back to shareholders.
Yeah, our mission today is really to boil down the most important bits from this call. We'll cut through the, let's say, corporate jargon, bring you the core insights, help you understand not just the numbers, but, why they actually matter for the long game, their strategy, and what it signals for mining overall.
Exactly. That's what we're here for. So get ready for a mix of pretty impressive financial results, some bold expansion plans, and some really interesting details on how they're tackling challenges right there on the ground. Let's dive in.
All right, so let's kick things off with those headline numbers. Teck reported an improved adjusted EBITDAAR of $722 million for Q2. Now, EBITDAAR, for anyone maybe less familiar, it's a key profitability measure, basically earnings before interest, taxes, depreciation, amortization, and rent. So what were the key things driving that profitability boost?
It's actually a pretty solid operational story behind that number. First off, their trail operations, they just kept delivering consistent profits, kind of a reliable engine for them. Yeah. But what really stood out was a net benefit they got from lower smelter processing charges. That flows right to the bottom line. Yeah. And maybe most impressively, they managed a huge 21% reduction in corporate overhead costs.
Yeah, that's a serious cut. It really signals a sharp focus on, efficiency. Now, it's important to mention these good things were partly offset by, market stuff like lower copper and zinc prices, and also some higher operating costs at two big mines, Highland Valley and QB.
Yeah, those cost cuts are definitely noteworthy. Sounds like they're not just focused on revenue, but really tightening the belt, so to speak. Beyond just the profit, though, a huge theme from this call was that commitment to returning value to shareholders. How did that actually play out this quarter?
It was a massive quarter for returns. Really underscores their financial confidence, I think. Teck returned an incredible $548 million just in Q2.
Wow.
And what's striking is most of that $487 million came through pretty hefty share buybacks. Then there was $61 million in base dividends. That brings their year-to-date total to over $1.1 billion returned directly to shareholders.
Okay.
And just to give you some context, they've now finished about 70% of their huge $3.25 billion authorized buyback program. So that's about $2.2 billion out the door, with roughly $1 billion still potentially to go. And they also strongly reiterated their plan between 30% and 100% of future available cash flows. That's a very, very strong signal about future shareholder focus.
That is a clear message, definitely. So when you look at all the profits, the cash returns, the liquidity, what's the big picture? What does it tell us about their financial health, their resilience, and their long-term vision? How solid are they right now?
Look, their balance sheet is remarkably strong. They reported $8.9 billion in liquidity. That includes a pretty substantial $4.8 billion just sitting in cash. Now, they did technically move into a small net debt position. That just means total debt slightly edges out cash. But, and this is key, that was mostly because they used proceeds from selling their steelmaking pole business to fund those big shareholder returns we just talked about.
Got it.
And they also mentioned they expect a temporary buildup of inventory at Red Dog to unwind in Q3. That's just normal seasonal stuff for shipping, not a long-term worry. So yeah, this kind of financial muscle puts them in a great spot to chase that really ambitious goal, doubling their copper production by the end of the decade.
Right. So that financial strength isn't just for show, it's fuel for that huge growth plan. And for Teck, that plan is all about copper. Let's talk about the foundational projects here, starting with the Highland Valley Copper Mine Life Extension, the HBC MLE. Why is this one so important?
This project is absolutely the bedrock of their copper strategy. The board officially gave it the green light for construction. It's totally pivotal if they want to hit that goal of doubling copper output by, the end of the decade. This project basically extends the mine's life way out to 2046.
Wow, 2046.
Yeah, incredible, right? 2 more decades. And they expect average annual copper production of about 132,000 tons. Management really hammered home its compelling returns and the fact that it secures access to copper, a critical mineral, obviously for such a long time.
It really sounds like a game changer for them. Now, the capital estimate, the cost for HBC MLE did go up a bit.
Yeah.
What was behind that increase? And it changed the risk profile?
Right, good question. The revised capital estimate is now CAD 2.1 to 2.4 billion. That's up from the earlier range of 1.8 to 2 billion. There are a few things going on there. It now includes project-level contingencies. It accounts for inflation, higher input costs, the usual suspects. It also reflects potential tariffs on construction materials. But here's the key part and why it's actually kind of a smart move strategically. It incorporates the accelerated purchase of mobile equipment, stuff they originally planned to buy later. Doing that now significantly de-risks the project, gets that crucial equipment secured up front, avoids potential delays down the line. They also mentioned all the major permits are done, and they're already mobilizing for construction. So things are moving.
That makes a lot of sense. Spending a bit more upfront to lock things down and reduce risk later often pays off. Okay, let's pivot now to QB, Quebrada Blanca. It's a cornerstone asset, huge potential, but it's also faced some, headlines during its ramp up. What's the absolute latest on its progress and the specific hurdles they're dealing with?
Yeah, QB's definitely been under the microscope. They have revised its production outlook for this year slightly downwards to 210,000 to 230,000 tons of copper. This adjustment, they said, is mainly because of ongoing work on the tailings management facility, the TMF.
Right, the tailing.
Exactly. That's where they manage the mine waste. And this specific development work has apparently impacted how much time the mill is actually online and operating. Despite this, they stressed they're still targeting achieving the full design production rates by the end of this year. And management was pretty clear. They see this TMF work as a one-time milestone tied to the ramp-up phase. They expect to sort these issues out this year, and importantly, ensure it doesn't constrain operations going into 2026. It's worth noting, too, the increased capital spending this year for the TMF, because they're having to move more sand further distances. That's now classified as sustaining capital. So just part of keeping things running.
Okay, so the TMF work is one piece, but QB also had that other issue, right, at the port facility, the shiploader outage. What's the situation there and the impact?
Indeed. That outage at the QB port, caused by a brake failure on the shiploader, the fix is now expected to take longer, stretching into the first half of 2026. However, and this is really the crucial takeaway they emphasize, there has been no production impact.
Really? No impact?
Not on production volume. They've successfully used alternative port arrangements and also maximized shipments to local customers, which frankly shows some pretty good operational flexibility.
Yeah, that's impressive.
There's only been a minor extra cost, about 10 US cents per pound on their net cash unit costs. And they are looking into insurance coverage for the incident, which might even offset that small cost eventually.
So it sounds like QB is, a classic example maybe of just how complex these massive mining projects can be in the real world. Beyond the specific issues, what do you think is the bigger lesson here for Teck?
That's a good question. I think it really highlights the sheer scale and interconnectedness of bringing a brand new complex asset like QB online. The lesson is probably about needing absolutely meticulous planning for every single piece, right down to the logistics, the waste management. It's also about building in redundancy and the ability to adapt, which frankly, they demonstrated with that shiploader workaround.
Right.
It's just a reminder that even the best plans can hit unexpected bumps on the ground. And it's how you react and adapt that really counts.
That's a great perspective. So looking beyond these big foundational projects, what about other growth avenues? Are there other irons in the fire for their copper goals?
Oh, absolutely. It's not just about Highland Valley and QB. They're actively moving forward with other high-return greenfield projects, brand new developments, specifically Zafranal in Peru and San Nicolas in Mexico. Both are targeting sanction readiness, basically, the final decision point by the end of this year.
Okay.
And importantly, these projects are apparently significantly less complex and smaller in scale than QB was, lower capital intensity too. So this more diverse portfolio approach really underpins that overall goal. Double copper production up to potentially 800,000 tons a year by the decade's end.
It is easy to get laser focused on copper, given that big strategic push.
Yeah.
But you mentioned earlier their zinc segment actually had a really strong quarter, surprisingly so perhaps. What was driving that?
Yeah, the zinc segment definitely deserves a spotlight this quarter. Profitability there improved substantially. A really remarkable 137% jump in gross profit before depreciation and amortization, hitting $159 million.
Wow.
Sales from their Red Dog mine were above guidance, which is always positive, and their net cash unit costs for zinc got much better, down to just 49 US cents per pound. A key reason for this was actually an updated operating strategy at their trail operations. They deliberately cut back on refined zinc production.
Okay.
and instead boosted production of higher margin byproducts, things like silver, germanium, other critical metals found alongside the zinc. That strategic pivot clearly paid off in a big way this quarter.
That sounds like smart management, adapting to the market to maximize value from the assets they have. Now, shifting gears slightly. Beyond the financials and operations, safety, and sustainability, there are obviously huge priorities for a company like Teck. What were the key messages on those fronts?
Yeah, absolutely critical areas. On safety, the company openly acknowledged the deeply saddening fatality that occurred back on April 22nd at Antamina. That's an operation where Teck has a non-controlling stake. They stated they're fully participating in the investigation, which is being led by the Antamina team, and importantly, committed to sharing any learnings across their own company and the wider industry to help prevent future tragedies.
Right, crucial.
On a more positive sustainability note, Teck was again recognized as one of Corporate Knights' 2025 Best 50 Corporate Citizens in Canada. That's actually for the 19th year in a row.
Impressive consistency.
It really is. And that recognition is based on a pretty comprehensive look at up to 25 different sustainability indicators. Everything from board diversity to resource use, financial management, shows a long-term commitment there. Okay,
so bringing this all together then, looking ahead, what's the sort of big takeaway message about Teck's future path, especially thinking about growth on a per-share basis, which is, what investors really track?
Yeah, the company seems laser focused on a few core things right now. First, finishing that QB ramp up successfully. Second, really driving operational excellence everywhere. Third, continuing those strong cash returns to shareholders. And fourth, obviously, advancing those copper growth projects. What's particularly interesting, I think, is the impact this is having and will have on those per share metrics you mentioned. Copper production per share actually jumped 54% last year. That was due to QB starting up and a big chunk of those buybacks being done.
Okay.
And looking forward, they see potential for another 33% to 50% increase in copper production per share by 2026. That's assuming QB stabilizes at full rates and they complete the rest of the authorized buybacks. So it clearly shows a commitment to growing value specifically on a per share basis, which is, ultimately what resonates with investors.
This earnings call really does paint a picture, doesn't it? A company juggling this really aggressive copper growth strategy with, the messy realities of bringing a giant project like QB fully online. But through it all, that commitment to shareholder returns and the strength from their diversified assets seem to provide a pretty solid foundation.
Exactly. You've nailed it. They're making these big strategic bets like accelerating spending at Highland Valley that actually de-risk their long-term growth. And they're doing that while actively managing these shorter-term headwinds, the transparency around the QB issues and the Highland Valley costs, plus having clear plans. It signals a pretty deliberate, thoughtful approach to creating value, I think.
Okay, and that brings us to our This Is Not Financial Advice segment. You know the drill. We pitch an outrageous but plausible trade idea based on everything we've just discussed. So put on your hedge fund analyst hat.
Yeah.
You're pitching the investment committee. They're skeptical. What's your play on Teck right now?
Okay, all right, here's the pitch. Listen up, committee. Given management's pretty clear confidence they'll resolve those QB tailings management facility issues by year end. And considering the really attractive long-term high return profile of that Highland Valley mine life extension project, my outrageous but plausible trade idea is this. Go long Teck, but strategically. Buy out of the money call options, maybe expiring mid-2026.
Okay, options. Why?
The thesis is simple. The market right now is over-discounting these temporary QB operational snags. The TMF work, the shiploader fix extending a bit longer. Management was very clear these are not impacting production volumes and they expect them resolved. Plus, that higher capital number for Highland Valley. It looks scary maybe, but it's largely a smart de-risking move, locking in critical equipment early, and the project offers decades of attractive economics.
So betting the market is too focused on the short term.
Exactly. This trade bets on the market re-rating Teck higher once QB actually hits its design rates consistently, and the wider copper growth story becomes clearer without these near-term operational distractions. And if you want to get really fancy, you could potentially juice this trade by simultaneously shorting a more volatile, maybe a single asset copper miner, one that doesn't have Teck's strong balance sheet or diversification. The idea is you capture the spread as Teck successfully de-risks its growth, while the market's attention shifts away from today's temporary challenges towards Teck's much brighter future potential. It magnifies the upside if the thesis plays out.
Intriguing. And definitely playing a few moves ahead on the chessboard. As always, this has been a fascinating deep dive, Amy, for clarity and maybe some unexpected insights. Thank you so much for joining us. We really hope this helps you connect the dots and maybe sparks a little more curiosity about the complex but vital world of mining and beyond.